Many people assume buying a home today is more expensive than it's ever been considering record high home values. This is true if you look exclusively at price, but there are several other factors that you should consider when you're thinking about buying a home. Interest rates have dropped substantially over the past few decades, and incomes have also increased. It may shock you to learn that the median monthly mortgage payment consumes a smaller percentage of the median monthly income than several other times throughout history. I'm Tim Hamilton with StellarQuest Real Estate, and this is our Orange County housing market update for June. If you like to stay up to date on the market, make sure you subscribe to our YouTube channel. And if you're thinking about buying or selling a home in Southern California, please feel free to call or email us anytime, and we're happy to let you know what we can do to help. In his most recent Orange County housing report, Stephen Thomas put together a really great chart that compares housing affordability over time. He looks at the average interest rate, median price of a detached home, and median income for each year. By using these numbers, he can calculate what the monthly mortgage payment would have been as a percentage of the median income. So when you're looking at this chart, the lower the percentage is, the more affordable housing is, and the higher the percentage is, the less affordable it becomes. So today we are currently at 44%. You can see that there were several years where housing was much less affordable. In 1980, it was 55%. In 1990, it was 50%. And in 2007, right before the housing market crashed, it reached its highest level at 59%. When you look at these numbers, it's possible to conclude that housing affordability has not yet reached a critical level to be concerned about. I wanted to point out that this affordability number is extremely sensitive to interest rates. When we look at our median detached home price of $1.1 million and our median income of $101,000, we can look at what happens to the affordability number when interest rates increase. If interest rates rose to 3.5%, the affordability number would rise to 47%. And if interest rates rose to 3.75%, the affordability number would rise to 49%. So you can see that interest rates play an extremely critical role here. If interest rates remain low and relatively unchanged, then home values could increase quite a bit before housing affordability starts to get into the 50% range. Over the past few weeks, the number of homes listed for sale in Orange County has remained virtually unchanged. We currently have an extremely low level of inventory, which is one of the main reasons the housing market is currently so hot. To put it in perspective, we can compare the number of homes listed for sale now to the average between 2012 and 2019. During that time period, there was an average 182% more homes listed for sale than we currently have today. Stephen Thomas doesn't expect inventory to start rising until interest rates rise and buyer demand starts to ease. Buyer demand dropped by about 1% over the past few weeks. It is expected to continue to drop slightly as many home buyers will become distracted with summer activities such as family vacations and going to the beach. The 5-year average between 2012 and 2019 is 7% less than our current reading for demand. So we have an extremely low level of homes listed for sale mixed with a relatively high buyer demand, and that is why the market is currently so hot, where homes are rapidly increasing in value and selling extremely quickly. If you're thinking about buying or selling a home in Southern California, please feel free to call or email us anytime. We are more than happy to talk with you, answer any of your questions, and let you know what we can do to help. If you like to stay up to date on the housing market, make sure you subscribe to our YouTube channel, where we upload our monthly housing market update and videos on a variety of other real estate related topics.